Welcome to our deep dive into collective investment schemes. If you're looking to diversify your portfolio and invest collectively with other investors, you're in the right place. Let's start with the basics. A collective investment scheme, CIS, pools money from multiple investors to invest in a variety of assets, such as stocks, bonds, and other securities. This diversification can reduce risk compared to individual investments. There are different types of CIS: mutual funds, exchange-traded funds, ETFs, unit trusts, and hedge funds. Each has its own unique structure and management style. Mutual funds are one of the most common types of CIS. They are managed by professional fund managers who invest in a diversified portfolio of assets. Investors buy shares in the mutual fund, and the price of these shares fluctuates based on the performance of the underlying assets. ETFs, or exchange-traded funds, are another popular type. They track an index, commodity, or a basket of assets like an index fund. However, unlike mutual funds, ETFs trade on stock exchanges and their prices change throughout the trading day. Unit trusts are similar to mutual funds, but they issue units instead of shares. These units directly reflect the value of the assets held by the trust. A fund manager typically selects the investments for the trust. Lastly, hedge funds are CIS that invest in a wide array of assets with the goal of generating high returns. They often employ complex strategies such as leverage and derivatives. However, hedge funds come with higher risk and are typically available only to accredited investors. Now, let's delve into how CIS are regulated. In the United States, the Securities and Exchange Commission, SEC, plays a vital role in the oversight and regulation of these schemes. This regulation ensures transparency and protects investors. Why should you consider investing in a CIS? The biggest advantage is diversification. By pooling resources, investors can own a portion of a diversified portfolio that would be difficult to achieve individually. Here's a common question: what are the risks associated with CIS? While they offer diversification, they are not risk-free. Risks can include market risk, liquidity risk, and management risk. Each fund also charges fees that can impact returns. For example, if you invest $10,000 in a mutual fund with a 1.5% annual fee, you'll be paying $150 each year. While this may seem small, over time fees can substantially reduce your overall returns. Let's see this visually. If we plot the impact of a 1.5% fee over 20 years on an initial investment of $10,000 with an 8% annual return, it'll look like this. Questions frequently arise about the liquidity of CIS. Liquidity refers to how quickly you can convert your investment into cash. Mutual funds typically offer high liquidity as you can redeem shares on any business day. However, other CIS like hedge funds may have lock-in periods. Another common question is about taxation. The tax treatment of your holdings in a CIS can vary. Dividends and capital gains are usually subject to tax, but the specifics depend on your country's tax laws. Let's take an example. Assume you're in the United States and you earn dividends and capital gains from your mutual fund. These earnings may be subject to federal, state, and local taxes, often at different rates. You might be wondering, how do I choose the right CIS? The answer lies in understanding your investment goals, risk tolerance, and investment horizon. For instance, if you seek steady income with low risk, a bond mutual fund may be suitable. Here's a real-life scenario. John has $50,000 to invest and wants to achieve long-term growth. He balances his portfolio by investing 60% in a diversified equity ETF, 30% in a bond mutual fund, and 10% in a money market fund. Now let's address some common pitfalls to avoid. One major mistake is chasing past performance. Just because a fund performed well in the past doesn't guarantee future success. Always look at the fund's overall strategy and management. Another pitfall is ignoring the fund's expense ratio. Even a seemingly low fee of 1 to 2% can significantly impact your returns over the long run. Finally, always read the prospectus before investing. This document outlines the fund's investment objectives, risks, and fees. It's essential for making an informed decision. We hope this comprehensive guide has provided you with valuable insights into collective investment schemes. They can be an excellent addition to your investment portfolio if understood and chosen wisely. Don't forget to like this video, subscribe to our channel, and click the notification bell to stay updated. Also, leave your questions in the comments below.